Frequency Electronics completely missed consensus this quarter. We are looking at a brutal Q4 revenue of just $15.4 million, which is down sharply from $20 million last year.
Yeah, that's a massive drop. And their full fiscal year 2026 revenue dropped to $63.2 million from $69.8 million.
Right. And the bottom line took a really heavy hit. The Q4 earnings per share was a loss of 50 cents, and they posted a full-year loss of 9 cents per share. But, and this is the crazy part, management did not flinch. Without pausing, they reaffirmed incredibly aggressive forward guidance.
Yeah, they didn't back down at all.
I mean, they are projecting a 3-year minimum revenue target of $150 million by FY 2029. So that is a 34% compound annual growth rate. Plus, they established a brand new minimum gross margin target of 50% and an operating margin target of 30%. With the inherently low trading volume of this stock, these conflicting signals guarantee extreme volatility. The market is just still trying to digest the whiplash post-earnings.
Which means we need to figure out if this management team is completely delusional or if they are sitting on an absolute gold mine. I mean, how do we reconcile a brutal year-over-year earnings contraction with this incredibly bullish multi-year guidance?
Because it feels like two different companies.
Right. So today we are stripping away all that non-recurring noise. We're going to examine the actual underlying margins and rigorously assess FEI's strategic pivot toward high-rate production. We have to see if that $150 million target is based in reality.
So to evaluate if management's target is just a pipe dream, we first have to unpack that massive margin contraction we just saw in the Q4 reported numbers.
Yeah, you have to look at the adjusted metrics.
Because if you just look at the JAP numbers on your screen, your first instinct is probably to run. I mean, seeing a legacy high-tech manufacturer posting a 1% gross margin for a quarter and a staggering negative 41% Q4 operating margin.
It's terrifying on paper.
It is. The assumption is that the core business model is just completely breaking down.
Right. But to find the true operational baseline, we really have to pull CFO Steve Bernstein's adjusted figures from the filings. When you strip out the one-time restructuring charges and the transformational investments, which we'll scrutinize in a bit, the picture changes.
So what are the actual adjusted numbers?
The Q4 adjusted gross margin is actually 36%.
Okay, that's a huge difference.
Yeah, and that adjusted operating margin swings from a disastrous negative 41% all the way back to a positive 1%. Looking at the full fiscal year, the adjusted gross margin sits at 41%.
Okay, I see that. But I want to zero in on CEO Tom McClelland's commentary because he explicitly called fiscal 2026 a, quote, year of digestion from a revenue standpoint.
Right, the digestion narrative.
Yeah. His argument is basically that they pulled forward a massive amount of revenue into Q4 of 2025, which was a 25-year revenue high. But, you know, I struggle to buy that at face value.
Why is that?
Well, year of digestion just sounds a lot like convenient management speak for dropping the ball on sales execution. Like when your revenue drops by nearly a quarter year over year, it's a little too easy to just point at last year and say, well, we were too successful back then.
Look, it is a massive red flag when management uses terms like digestion. You have to immediately look for independent verification that the underlying business isn't actually starving. But if you check the order book, that narrative of a demand problem completely falls apart.
How so?
The funded backlog just hit a record $111 million.
Wait, if they're sitting on $111 million in funded orders, how do they only pull in $15 million in a quarter? Are they just failing to build the things they sold?
No, it really just comes down to the mechanics of government contracting. That funded backlog is up 34% sequentially from just Q3 and up 59% annually from the $70 million they reported at this time last year.
Wow, so the pipeline is full.
Crucially, funded backlog isn't a pipeline of maybe deals. These are committed, fully funded orders with the government or major prime contractors. The revenue drop this year is a timing issue. It's about when they are legally allowed to recognize the revenue on these multi-year contracts. Demand is actually accelerating rapidly. They just haven't hit the accounting milestones to claim the cash on the income statement yet.
Okay, but even if the demand is real, we still have to explain the margin collapse. Robust demand doesn't excuse a 1% reported gross margin. We need to look under the hood at what management is actually cutting because something blew a massive hole in the Q4 P&L.
Yeah, and the primary culprit dragging down the quarter is the restructuring of their FEI Elcom manufacturing business in New Jersey.
Right.
Management basically audited their portfolio and determined the Elcom unit simply lacked the growth and margin profile of their core focus areas.
Yeah.
It just didn't fit the future state of the company, so they shuttered it.
And when you shut down a manufacturing unit, the inventory you have sitting on the shelves suddenly loses its value. Accounting rules force you to take that loss immediately on the books.
Exactly.
So they took a $3.8 million non-cash inventory write-down on Elcom. That entire $3.8 million hit their cost of goods sold all at once in Q4. It crushed their gross margin on paper, even though it wasn't an operating failure of the core business in that specific quarter. Plus, they had severance costs that flowed through their SG&A.
Right, and if you look at the reconciliation tables, their reported Q4 cost of revenues was $15.2 million.
Yeah.
But when you pull out that $4.3 million in total restructuring costs, the underlying business looks significantly healthier.
It's honestly like, I don't know, amputating a slow-moving limb to win a sprint. You take a guaranteed, highly visible, near-term hit to your revenue today, but you free up the engineering talent and the capital to go after much larger addressable markets.
Yeah, and if you dig into the tax implications of that write-down for you as an investor, you suddenly see a massive shield protecting their future profits.
Oh, right, the tax benefit.
Yeah. While that $3.8 million inventory write-down looked terrible on the Q4 income statement, it actually reduced their taxable income, yielding an immediate $2.9 million tax benefit in Q4.
Okay, that helps soften the blow.
And furthermore, including all the restructuring costs, the company anticipates a total future tax benefit of roughly $9.3 million. That is $9.3 million in future profits that will be shielded from taxes as they scale back up.
So they take the accounting pain, they secure the tax shield, and they redirect your focus. But where is that capital actually going? Like, what are they chasing?
They are aggressively reallocating it to ultra-high growth, highly complex sectors. So they are pushing into ALT-PNT alternative position, navigation, and timing solutions. They're going heavily into quantum sensing, specifically magnetometers, plus space defense and proliferated satellite programs.
Let's pause on the quantum sensing for a second, because the term magnetometer gets thrown around in these earnings calls without much context.
Yeah, it sounds a bit out there.
Right, but a magnetometer is just an incredibly sensitive device that can navigate by reading the Earth's magnetic field. So if GPS goes down in a war zone because an adversary jammed the signal...
Which happens a lot now.
Exactly. These quantum sensors allow a satellite or a drone to know exactly where it is based solely on magnetic signatures. That is why defense funding is pouring into this specific technology. It is mission-critical redundancy.
Which is exactly why FEI wants to corner that specific market rather than keeping a low-margin factory in New Jersey running.
But look, closing a factory doesn't magically generate a 50% gross margin on hardware. To actually hit those aggressive numbers by 2029, they have to fundamentally change the geometry of their factory floor. How do they actually scale up to 50%?
This is the most critical operational shift buried in the management commentary. Frequency electronics is fundamentally changing how they build things.
Yeah.
They're transitioning from being a bespoke manufacturer of exquisite products with episodic stop-and-start production schedules to a true high-rate production company.
And to understand why this is a make-or-break pivot, you have to look at the macro shift in the space industry. I mean, for decades, the space industry was about launching one massive bus-sized satellite into geosynchronous orbit.
Right, the billion-dollar project.
Exactly. It cost $1 billion, took 10 years to build, and had to last for 15 years. FEI built a 25-year legacy, crafting the incredibly precise one-off time and frequency products for those massive satellites. They were basically the artisans of space hardware.
But the entire industry has shifted to low Earth orbit, or AEO, proliferated architectures. Think of the Starlink model or the Space Development Agency's new defense constellations.
Right, volume over size.
Exactly. The government isn't buying one exquisite clock or one massive satellite anymore. They're buying hundreds of cheaper, smaller satellites at a time, and they need them delivered constantly. FEI literally has to move to high-rate production because their customers' purchasing habits have permanently changed.
So let's look at the financial mechanics of high-rate production. When you are making many more units of standardized products on a consistent basis, you get drastically better overhead absorption.
Right, the factory's always humming.
Exactly. If your factory is constantly running, your fixed facility costs, the rent, the lights, the baseline staff, are spread over a much larger number of units. That mechanically lowers the cost per unit.
It also completely rewires their engineering profile. Moving to high-rate production leads to significantly lower non-recurring engineering costs, or NRE, as a percentage of total revenue. When you build bespoke, one-off satellites, every new contract requires a heavy, expensive burst of custom engineering right up front.
Because you are basically inventing a new product every single time.
Precisely. But when you shift to high-rate standardized production, that initial engineering cost is amortized over a massive production run of hundreds of units. That amortization is the primary lever they are pulling to drive those gross margins from the mid-30s all the way up to 50% by fiscal 2029.
But making that shift is brutal on the current financials. FEI hired a massive wave of engineering talent in advance of this anticipated production ramp-up. They expanded into Colorado in fiscal 2026.
Yeah, the costs hit way before the revenue does.
Exactly. And because of strict accounting rules, these transformational engineering costs flow straight through the manufacturing overhead portion of COGS. I kind of look at this like opening a massive high-end restaurant. It's like paying a full, expensive kitchen staff and completely remodeling the dining room for 6 months before the grand opening.
Right?
The overhead burns cash today, and it makes your current profit and loss statement look terrible, but you have to do it to handle the volume later.
That works perfectly for the overhead analogy, but it's actually much harder than a restaurant. I mean, in space hardware, you aren't just training chefs. You are re-engineering the actual recipe of how a satellite clock is built so it can be mass-produced without failing in zero gravity. So you have to literally design the manufacturing process itself.
Which explains the massive costs hitting the books right now. In Q4 alone, they absorbed over $718,000 in transformational employment costs right into their cost of goods sold. Plus, they poured another $323,000 into a business improvement transformation, which is a manufacturing efficiency project to improve their turnaround times.
Yeah, the cash is flying out the door to build the machine that builds the product.
Right.
But that operating leverage is exactly how they plan to hit their 30% operating margin target. Once that $111 million backlog starts converting into sharply increasing revenue, their R&D and SG&A expenses won't need to grow at the same pace. The fixed costs stay relatively flat, the revenue spikes, and the profits drop straight to the bottom line.
And didn't CFO Steve Bernstein say something about cash flow?
Yeah, he noted they expect to return to normal cash generation beginning in the current fiscal first quarter of 2027. So the period of heavy unabsorbed investment is supposedly behind them now.
Okay, so the transformation story is mathematically sound. If they execute, the margins will expand. But as financial analysts, we have to look closely at the forward-looking statements to see what could actually derail this $150 million revenue train. What are the major risks threatening this pivot?
Well, the primary vulnerabilities center around their customer base and their contract structures. FEI is heavily reliant on key customers, specifically the U.S. government. Their precision technology is baked into commercial and U.S. government satellites, as well as C4ISR systems.
Command, control, communication, computer, intelligence, surveillance, and reconnaissance for those tracking the acronyms.
Exactly, and electronic warfare systems.
But when the U.S. government is your ultimate end customer, you are entirely exposed to federal budget continuing resolutions, political shifts, and changes in defense spending priorities. If Congress can't pass a budget and operates on a continuing resolution, new contract awards freeze. And FEI can't control that.
No, they can't. And beyond the macro politics, there is a massive internal risk regarding how they account for these contracts. Because of the nature of these multi-year defense projects, the company relies heavily on percentage of completion accounting.
We should definitely clarify how that actually works because it's a trap for a lot of manufacturing companies. Under percentage of completion accounting, management has to estimate the total cost and the total timeline of a project in order to recognize the revenue proportionally over time. So if they estimate a project will cost $10 million and take a year, they recognize revenue as they hit milestones against that estimate.
But if those internal estimates are off, say a component gets delayed by 6 months or the engineering takes twice as long, future margins suddenly compress. They're forced to recognize those cost overruns, which retroactively makes the contract less profitable than they initially reported to investors.
And those cost overruns could easily be triggered by the external threats mentioned in their filings, particularly supply chain disruptions. I mean, in the commercial world, if a supplier is late with a microchip, you just call a different supplier.
Right, you just swap them out.
But in the highly regulated defense sector, you can't just swap out a vendor. Every single supplier has to be vetted, audited, and certified by the government. If one certified vendor has a bottleneck, FEI's entire production line stalls, their percentage of completion estimates blow up, and their margins shrink.
They also highlight the increasing risk of cybersecurity attacks. When you are dealing with classified or proprietary space defense technology, and specifically alternative navigation systems for when GPS is jammed, you are a prime target for state-sponsored cyber espionage.
Absolutely.
And a breach doesn't just cost money to fix, it can cost you your actual security clearance to bid on future government contracts.
That's a massive risk. I also want to specifically call out a crucial market risk for anyone looking at trading this stock based on this turnaround story. The filings explicitly note the volatility in the company's stock price due to the relatively low trading volume of its common stock under the NASDAQ ticker FEIM.
Yeah, low liquidity is always tough.
Right, because it inherently leads to high price volatility, regardless of how well the underlying business actually performs. A single institutional investor deciding to buy or sell a block of shares can swing the price wildly. If you are managing your own portfolio, you have to actively monitor that liquidity risk. You could be entirely right about the fundamental turnaround of the business, but still get caught on the wrong side of a massive liquidity-driven price swing.
It happens all the time in microcap defense stocks. The fundamental thesis plays out, but the entry and exit points are chaotic.
Definitely. So let's bring all of this together. The brutal Q4 GAAP numbers basically hide a company that is intentionally absorbing short-term pain. They took the hit on forward-looking engineering hiring in Colorado to prepare for volume. They took the $3.8 million hit on the Elcom inventory write-downs to shed low-margin deadweight. And they pushed through a major manufacturing efficiency project to speed up the factory floor.
Yeah, and all of this was done to service that record $111 million funded backlog and position themselves for the massive shift toward proliferated low-Earth orbit constellations and quantum sensing.
They are essentially tearing down the old bespoke model to build a highly scalable, high-rate production engine, but they are trying to do it on the exact same foundation of technological excellence.
Which is an incredibly hard needle to thread.
It really is, which leaves you with the final strategic question to mull over as this all plays out. Frequency Electronics has built its entire 25-year legacy by crafting precise, one-off-time products. They won over 150 space programs by being artisans. As they pivot to this high-rate, standardized production model to chase those 50% gross margins, can they actually scale their output without commoditizing the very technological edge that made them a market leader in the first place? Like, can you actually mass-produce the exquisite without losing your soul as an engineering firm?
That is the multi-million-dollar test for this management team over the next 3 years. If they can, $150 million in revenue is well within reach.
We will be tracking that order book closely to see if they pull it off. Make sure to follow the show for daily, no-nonsense earnings coverage, and we will see you on the next deep dive.